Assalamu alaikum. Before we look at the types of companies, there was one slide left behind which we have to discuss, which is about some issues we still have to look at in terms of liability. As we had last time, the point of limited liability and limited liability for shareholders, it's not for the companies, but still sometimes some issues we have to look at. One of them is the responsibility and liability of the company. Do you think that companies will be liable for any act, for any activity it can make or not? I guess yes, because companies have its own or their own names and personalities completely separate from shareholders. But we have some cases in which we have to look at the diffused responsibility, in which we have to understand the action and the consequences. If something happened to the customers, if an action was taken and that was an illegal action, and this action was made by the company, who will be responsible? What do you think? That company, shareholders, employees, managers, who will take the responsibility for this action? This is what we call it diffused responsibility. We don't know exactly who is the responsible person. If a corporation found liable for death of somebody, who will take the responsibility? And you know that corporations and companies will not be able to kill anyone physically, but they can cause the death of somebody. Somebody passed away because of legal action, or legal action was made by the company. Then we have to look at the responsibility. Will it be the company itself, shareholders, employees? Who will be liable for such action? What do you think? Who will take the liability? We said if we lose as shareholders, we lose the amount of money we invest. This is the maximum. The potential loss will be the amount of money we have invested. But when it comes to the case like this, we have a mistake was done by the company, and this mistake caused the death of somebody, or this action has caused the death of somebody. Our customer, most likely will be a customer, or it might be sometimes an employee. Who will be responsible, the company or the shareholders? Yes? What do you think? No answer? Well, as Daria said, that it might be the board of directors. Some scholars said shareholders will have to take the responsibility because they own the company, and the shareholders, they run it, they manage it.
But they give the responsibility for the
good. So if the shareholders would take the responsibility, it means somehow that the board of directors would take the responsibility, will be liable. In any way, that some scholars said shareholders would be responsible, but it's not easy to define such case saying that shareholders will be responsible, because sometimes we have thousands of shareholders. In some companies we have millions of shareholders. How can we make sure that they will be responsible for such action? How can we judge that big number of people for an action which was made by the company? This brings to our mind the question of the responsibility of the company or the corporation. Will it be able to pay for this fault or this mistake? Will the company be judged for such a mistake? If somebody was killed or passed away because of activities made by the company, then the company would have to pay for this, would have to pay for this action. This can be paid by the shareholders, by directors. It can be paid by the company itself. Still, this is one of the cases which is not solved, which we call it it's unresolved issues. We don't have a final solution. We cannot have a definite solution here. We have to look at each case. Maybe the responsibility will be on the member of staff. It might be on the employees. I mean, one of the employees have caused the death of somebody. This action here, this action, the company will not pay for it. It's that person who caused it. But if the company itself has caused this death, then we have many answers. Some are still saying that shareholders would have to pay for it. Others say that the company would have to be. The company would have to. Until we get to the point in which some scholars even raising the question of the death penalty, saying that the company has to be executed, killed, end its life, because the company has ended the life of somebody, then we have to end the life of the company. I mean, we still do not have that answer yet. It depends on the case, and it depends on each country what they have. Fine. I think we have to move to the next slide, to the new subject now, in which we have to differentiate between different types of companies and corporations. Oh, it's good. I see many students today. Some of them are late. Fine, anyway. We have the types. How many types of corporations do we have? 2, 4, 5? How many types of companies do we have? How many? What do you think? 5? 4?
4. No. 5.
It depends on each country. In Palestine, we have 3 main types of companies. In the USA, you might have maybe 10 types. I don't know exactly how many types. It depends on each company law. In each country, they have different systems. But most likely, most places and most countries, most jurisdictions, we do have similar shapes and types of companies. Here, most corporations, most of them, most companies as well, registered with the local jurisdiction. منطقة اختصاص قانوني. Jurisdiction as stock or non-stock, profit or non-profit. It's up to you. You can say stock company, non-stock company, profit or non-profit. Some places like here saying it has to be named stock corporations. What does it mean? You might have a question and you have to think about it later on about the difference between a stock and non-stock company, stock and non-stock corporation.
This corporation raises its capital by selling the stocks to the stockholders and the general customers.
Yes. Anyone else? What does it mean, stock? Asset, shares, assets, money, profit. It means this company investing money to make a profit. And it's a collection of people united together, collection of individuals united together to make money, to make a profit. They have intention, and this intention is to make business, not for the sake of the business. No, it's for the sake of the profit, of the money. It's a profit. It's for a profit corporation. To make that profit at the end of the day, the outcome, the income we would have at the end of that time. And this type we call it stock corporation. The non-stock corporation, it's not. We don't have the stock. We don't have shares. No money invested. No intention to make a profit. What we have? Members. What they have intention. What kind of intentions do we have? Do they have? What they want to do. I'm not talking about voting and that mechanism of selecting or electing directors. I'm talking about the business itself. Is it business or is it not?
Their main business is a charity business.
Charity. Yes. This non-profit, it's a non-profit and it's non-stock. It's not business, it's not profit, it's not money. It's about some activities. Those activities can be charity, helping people, services, academic style research, medical, educational. We have many types of non-profit corporations or non-stock corporations, in which we have in Palestine many NGOs. We have hundreds of NGOs, non-governmental organizations, but even those were established under the title of non-stock. They don't have the stock, no money, no stores, no investment, no shares. All what they have, intention to do something for the benefit of the whole society, or for the benefit of some people in that society. And by doing this, here, you might need some money to be invested, but this money just to facilitate, to help you to be able to understand how life can be managed. I mean, social life, educational life, how you can help some people. In both ways, as you can see, stock and non-stock corporations. In the United States, like in Washington, for example, some jurisdictions اللي هي منطقة اختصاص قانوني, like jurisdiction of Gaza City, jurisdiction of Nablus, and so on and so forth. In some jurisdictions, Washington DC, for example, here, despite the fact that they separate between stock and non-stock, but we find that we have some similarities sometimes in the structure. And they say what they call them profit and non-profit, profit and non-profit. And we will see later in the next slide that even if we have here two types, profit and non-profit companies, we have the same structure. We have managing board, members, assets, and so on and so forth, as we will look at right now. Yeah. As you can see that again, we're just repeating the same thing but in a different way. Repeating the same point in a different way. It was stock and non-stock, but now we call them profit and non-profit. As in modern economic system, conventions of corporate governance commonly appear in either business or non-profit. I mean, profit and non-profit, business and charity. This depends on the law in each country. Like I said, in the States, in Washington DC, they don't call them stock and non-stock, but they call them a profit and non-profit company. For me, it does not make difference. As long as both companies, both corporations are acting in the same manner, then it's the same result. Doing something in the market, achieving money or achieving benefit for the whole society. This depends on the state and the statute, and depends on the law itself. The law. Just need somebody to read this sentence here for me. Someone, Dalia.
The courts often interpret provisions of the law that apply to profit-making enterprises in the same manner or similar manner when applying principles to non-profit organizations, as the underlying structures of these two types of entity often resemble each other.
We have two entities, stock and non-stock. They look like the same. And even if we have any case before the judge in the court, he or she would make the same decision in most cases. Why? Because we have the structure. The structure here, البنية, the framework, both entities, they look the same. Like let's say that we have members. In non-profit companies, we have individuals, members. In a profit company, we have individuals, but they call them shareholders. Human being and a human being, most likely. We have election, yes, we have election in both types. We have article of establishment. How can we establish it? We have to have the documents. The article of establishment, عقد التأسيس, and we do have to have by law in both. So looking at both entities, they look the same. I cannot see much difference between them except for what? Yes, the goals, the intention, the objectives, to make money or not to make money, to invest in business or not. But the physical side, they look the same. The structure, the assets and everything, it looks the same. And this is taken into consideration once we look at both types of companies or corporations from a legal point of view and from judicial point of view. I mean judicial, when we take the case to the judge in the court, we'll look at it same manner, take a decision in a similar way. Now we have to look at completely different section of the types of corporations or companies, as most of you know about it, public and private. Companies can be divided into public or private companies. Corporations, public and private. We call them sometimes closely held and publicly held. Publicly traded corporations and closely held corporation, the same thing, public or private. Let's begin with public companies. When the company can be public and when can it be private? What do you think? This is not difficult. This is not a difficult point. Easy. Companies can be public and sometimes they can be private. How can I know this? How can we establish public company? How can we establish a private company? How can they run? Is it the same way? Do they have the same structure? Is it not? The same liability or not? Come on, just try it. Make mistake, it's fine.
Private company, it's the main objective in order to make a profit. But most likely in public companies provide service.
No, it's not like this. That is called it profit and non-profit, charity or mutual benefit. No, this is not the situation. We're not looking about this. Talking here publicly traded.
Public funds from the government, but private funds from
No. Okay. Forget about public company. Call it publicly traded companies. Publicly traded corporation. Traded.
In publicly traded corporation, it's managed by a larger group of managers and people, and it's ready to publish shares for the general public. And the closely held corporation, it's a private held corporation managed by a small group of people, and it's not ready to publish shares to the general public or to the market.
Okay, publicly traded corporations, we have a larger size, big size of this company, and closely held corporations most likely small in size. Small in size here, if you look at the size, for example here, size number 1, we look at the numbers. Number 2. But the main point is the public market. In publicly traded companies, they are listed on the stock exchange. And how many of them we have? Like in Palestine, for example, we have less than 40 companies who are listed on the stock exchange. In the United States, for example, we have a New York Stock Exchange, and only a small number of corporations are listed on the stock exchange, in which we can buy shares, we can sell, we can exchange. It's an open market, open for anyone. You can buy shares as many as you can sell, you can exchange, you can leave the company, you can join anytime you want. We don't have restrictions on the money. We don't have limitation on the number of shareholders. It's open to anyone. Then you might have 1 million shareholders. You might have 5 million shareholders. Okay. The main distinction between publicly and publicly and a closely held corporation is closely held corporations are not listed on the stock exchange. They are not listed. Then in these companies here, you will not be able to buy shares in the market. Like سوق الأوراق المالية, البورصة. Like in Palestine, we have Bank of Palestine, we have Jawal Company, we have Baltil, I guess. We have about 37 corporations are listed on the stock exchange market. So you can go to that market, you can buy shares, and then you can exchange, you can sell them if you want. And it means here, those corporations in size are largest. They are the largest in size, largest business in the world, publicly traded corporations. In the size here, closely held corporations are small. You might have sometimes here 5 shareholders, 2. It might be 50. Most likely family. It's a family business. Friends. People who trust each other. You might have a small number of people knowing each other, trusting each other, in closely held corporations, meaning here no market exists. We cannot trade in the shares of such companies. If you want to join such company, small size, closely held corporation, you would have to take permission from shareholders. If you want to leave, everything has to be with the acceptance of the shareholders. You have some limitations on a number. You can know the amount of money we invest. But when it comes to publicly traded corporation, we have the freedom to join and to leave, to invest money and to sell your shares the way you like it. So in number, majority of corporations are said to be closely held. Closely. Most companies in the world are private or public? No, private. Most of them, numbers. How many? In Palestine we have thousands of companies. We have thousands of companies. How many of them are publicly traded in the stock exchange? I think it's about 37 only. Only 37 companies. I'm not sure about the number, but it's a little bit more or less. 37 companies are only listed on the Palestinian stock exchange market. Only. But the rest of them closely held, private companies. Because to be listed on the stock exchange market, it has to be huge in size, investing millions and millions of pounds and dollars. And you have to have the responsibility, you have to have some conditions. It's not easy to join and list your name in the stock exchange because you have some danger, some risk. You might lose control. You have to abide by the system. In next few slides, you will see the difference, the main difference between public and a private company. It's about restrictions, limitations, law. How can we impose things on such type? Because investing too much money, such publicly traded companies would affect the whole society. And if we have a bankruptcy here, then thousands of people will be affected. But when it comes to public, when it comes to closely held, when it comes to private companies, it's only about small amount of money invested, and a small number of people, shareholders. So even if we lose this company, even if we have an end of its life, this would not affect the economy in the country. It will not. And even despite what I'm saying now, sometimes we find closely held corporations really large in size. I mean, they will not stop. Those closely held corporations, private corporations, they will not stop. They will not at one point. They keep growing and becoming bigger in size, larger in size. Now here, size. Although the size of such corporations can be as vast as largest public corporations. But the main difference again is the stock market. Here, stock exchange. Can we sell? We cannot sell publicly. Fine? Good? Now we have to look at the advantage and disadvantage for both. Advantage and disadvantage, public and private. Most advantages are connected with closely held. We find it easy to establish private company. We find it difficult to establish public companies. Why? Because we have some advantages here for the closely 1, 2, 3. These advantages only for the closely held, and one advantage for the public companies. Let's look at them one by one. Decision making. It's easy to make decisions in a private company. If we have a small number of people, like 20, 25 students here, it's not difficult to make decisions. But if I have a class of 250 students, it will be a little bit difficult. If you have 20,000 students, it's even more difficult. Now, same thing with companies. If you have a small number, like closely held companies, often make a changing decision or decisions much more rapid, easy, faster than publicly traded. Because most likely the decision will be connected with the money we invest, with the status, with the business, with the values, many points. Then we find it easy to make decisions in closely held companies than publicly traded companies. That's number one. Number two, it's talking about the community and being in one place and having the trust with the people and the society. And it's a little bit difficult or complicated here, but it's talking about the community. Most small companies are well established in one place. Most small private companies can stay in one place, and you can see that in some areas. You can see one small company existed for the past 50 years or 20 years. The same people working for that. It can be a family business. You find some stores under the name of company, and this store existed in Gaza City for the past 30 years. But big companies will not be able to exist in one place and to keep good contact with the community. Small company, your business, you can keep it, you can look after that business, after that small company, and you can have a strong relationship with the consumers. Even sometimes what you can do in small companies, private companies here, you can take some of the risk, even if it was with a limited liability. Sometimes shareholders in small companies, in the private companies, they can share some of the liability. Because if I don't share here, shareholders, they can incur some of the damage. Despite we know in a company or corporation, in a corporation we have a limited liability. But in some cases, like to keep our business alive, to invest more, to support it, to boost it, then we have to take some responsibility. I'm not gonna only lose the amount of money I invested, I might even lose more, but I want to keep my business alive. I want to sustain it. Then I would keep my relationship with the community as strong as ever. You get the point? I mean, small companies in size, private companies, they can sustain their relationship with the community better than publicly traded companies. Okay? And number three here, closely held companies, they often or most likely here what they have, better relationship with employees. Imagine that a small company having only 50 employees. Most likely they would know each other. Some companies, they have only 10 or 20 employees, workers or laborers. And even if you have 200, that's not a big number. But there's some public companies, public traded companies, they have thousands of employees. They have hundreds of thousands of employees. Then most of them, they will not know each other. Now, in closely held companies, often we have better relationship with workers. You find the manager, the owners, the shareholders can sit down together with the workers, with the employees. They can support them. They can sustain their relationship together. And this is not the same like in public companies, as we're going to see in the next slide, what the consequences we can have if we have some loss. Who can take it? In a private company, it's not easy for the shareholders or for the owners of the company to put this responsibility on the employees. They can take part of that. In public companies, we find it's not the same. As we look next slide, then you can cut the number of employees. And one advantage of public companies is, can you read, Amalon?
Publicly traded companies often have working capital in and out and delegate debt throughout all shareholders.
Okay, in public companies, publicly traded companies, it's easy to make money. It's easy to raise the capital and to increase the number of shareholders. And this is an advantage, because once we increase the capital, the money, and once we have many shareholders, then we're going to be able to make more business and to make more profit. And this is not something can exist in small companies and in private companies, because those private companies will not attract many shareholders as much as public companies can attract shareholders. You're going to have sometimes even millions of shareholders in public companies. At the same time, you might have only a small number of shareholders in a private corporation. Looking at the disadvantage of publicly and closely held corporations, it's the opposite. You find here, number 1, 2, 3, disadvantage with public, and 1 with the closely held corporation. So look at number one here.
In publicly traded companies are at the mercy of the market, having capital flow based not only on what the company is doing for the market and even what the competitors are doing.
Good, as you can see that capital flow, the amount of money we invest, the value of that money, the value of the share, the value of that company, we cannot sometimes control it. Especially the capital, the amount of money we invested in that company, it can be affected not only by the policy of that company, of the corporation, but it can be affected by the market. Though here you can see that having capital flow based not only on what companies is doing, sometimes the capital or the money we invest can be affected, whether positive or negative, by the activities in the company. But how much money they sell, how much money they invest, how many items they can sell in the market per week, how many customers they have. Not only this, but even the capital of that company is affected by the market, by competitors, the munafisin. Because this is not the only company. It's not. We have millions, we have thousands of companies, thousands of corporations. In small size corporations, in the private companies, we don't have the same thing, because the private companies would keep a limited amount of money invested in the market, and they might be affected, but they will not be affected as much as public companies. Publicly traded companies can easily be affected by the market. Sometimes you see, if you look at the Nasdaq Stock Exchange, New York Stock Exchange, Tokyo Stock Exchange, you find sometimes the signal going up and down. You find within the same minute sometimes, even the price of the share going up and down. Based on what? If it was my company, our company, we will not be able to control everything. You have the market, you have the competitors, you have to compete with them, and they would affect your capital. And this is not advantage, it's a disadvantage for corporation. Number 2,
publicly traded companies often comes under extreme
scrutiny.
If profit and growth are not evident to stockholders. Thus, stockholders may sell, further damaging the company. This is enough to make a small public company fail. Okay,
we have something which is the main difference between publicly and closely held companies. It's the scrutiny. Scrutiny والدقة. Extreme in publicly traded companies, we have scrutiny, دقة, we have extreme procedures, we have tighter procedures. If you would like to establish public companies, it's too difficult. It's not easy. You have to go through lots of procedures and time and money and complications. If you would like to have a small company in size and a private company, it's not difficult. It will be easier than having a public companies. Now, because of this, because of the extreme scrutiny, sometimes the company would be asked about the profit. Where does it come from? How do you get this money? How much money you have made this year? Then this would raise the doubt about the possibility of such companies staying in the market if it was not following legal procedures. Then this would affect the shareholders in a bad way. Some of them would leave, and if you have some shareholders leaving the company, this would be affected in a bad way, in a negative way, and they might close down at the end of the day. Some corporations in this here can be affected. This is a negative point because small size companies will be monitored, will be inspected by the company inspectors. But large size companies, public corporations, they will be inspected, but not the same way. They are not in the same way. Public companies, they would have tighter procedures. They would have longer process of inspection and monitoring because they invest a hell of money, millions and billions of pounds and dollars. They will have to make sure that everything was going in the right way. And this, as I said at the beginning, this would make some shareholders doubt about being or staying in such corporations or not, because you might not know in the future what would happen to you and to that company. And this would affect it negatively. Not the same like a private companies. In private companies, small size, small number of people, we know the amount of money, we know everything, how everything can be done. And number 3 disadvantage here, as I mentioned last slide, I was talking about the relationship between laborers, workers, and
employees
and the owners of the company. In small companies, small corporations, we have a strong relationship between the owners, the shareholders, and the employees and the workers. When it comes to the public, it's not. Public corporations having thousands of shareholders, and sometimes they're having even thousands of employees. Sometimes those corporations would be affected by the market, and thus they lose money. And then the company will not be able to run as it used to be last year or the year before. Then the most people to be affected here, not the shareholders, and most likely will be the workforce. They can cut the hours, working hours, cut the number of employees and the workers, and they can even cut the benefit and the bonus. Everything here can be used against the workforce. This is because we have a huge number of employees and workers, and we will not be able to cover all expenses. They cost lots of money, millions and billions. Then to pay them will not be fair for the company to be able to pay all of those people. Then the only way for them is to cut the hours or to reduce the number of employees. And you have seen many examples in the past few years in Spain, in Italy, in the United States, in the UK, in many other countries, in Greece. Cutting the number of employees, many people become unemployed. They cannot find any job. They cannot find nothing to do. And the state would have to sustain them. The state would have to give them benefit according to the welfare system. One disadvantage for the closely held corporation here, it's the closely held corporation in business, shareholders can incur profit damage. Because we have sometimes in such case here unlimited liability. A closely held small company, small number of people with unlimited liability, then those people would have to take the final responsibility paying the debt. Not only their debt, but they have to pay the debt of the company itself to be able to stand and to be able to respond to the need of the society. Well, this is most likely mentioned in the contract between the employees and the company. And of course, they will give them notice. If you work for a company, you can get a notice 4 weeks, 1 month, 2 month notice, asking you to end.
He can go to the court.
It's not easy. It's not easy because in the contract can be said that the company can hire and can fire anyone, not anytime, but of course will give a notice. There is a notice between the two sides, and this notice, it will be most likely 1 month. It can be sometimes 2 or 3 months, in which I would ask you to leave the company, but I will give you 1 month notice. Okay? Well, after 4 weeks or after 6 weeks, we don't need you anymore. It's like this, it's easy. And especially if the company does not have opportunities anymore and no vacancies, and the company in this case will not be able to pay people for nothing. Again here, despite the fact that we have some similarities between public and private, we have many similarities between the two sides, two entities, publicly and closely held corporations. Despite this, we have one main difference between them, which I mentioned before, which is the law. What do you mean by this? Not really. No, the goals are the same. But one of them is small in size, and the second one is large in size. The same goal. We're talking about the size, the number, and scrutiny. Inspection. The main difference between them is publicly traded companies and publicly traded corporations have the burden to abiding by additional scrutiny is law. This does not exist. This is not connected with closely held corporation. In a closely held corporation, easy to establish, easy to run, to make money, but you will not be able to expand the size of that company. When it comes to public, as I mentioned before, we have additional scrutiny law to make it difficult for people to have such public corporations. Otherwise, if we're going to make it easy, we would have hundreds of public companies and getting the people money, taking people money, investing them, and then you might have no inspection, no good inspection, in which some companies would collapse, some companies would fail to meet the annual requirement. Then what would happen to the company? What would happen to the people who invested the money, shareholders? This is why we have to make it difficult for anyone who would like to establish publicly traded corporation, because we look after the money, the benefit, the economy, and the welfare system, and consequently we would have for publicly traded companies extra 1, 2, 3 main points. Number one is we have additional periodic disclosure. Disclosure this is one of the means and methods which can be adopted by company inspector. Company inspector can come to the company anytime, asking for the documents, for the accounts, looking at everything in the company. This is what we call disclosure, ifsah, disclosure, kashf an. And we can have even additional periodic disclosure. Number two,
governance
standard?
The standard of governance, how can we manage, how can we run such corporation? This standard have to be strict, even more difficult than any other corporations, because we have to make sure, because decisions are made by whom? Who makes decision in corporation? General managers, board of directors. Then we have to have governance standard, strict, tight, because we cannot leave it to that small number of people to make whatever they want. We have to look after their activities. We have to make sure that those people, that small number of people who were elected by shareholders, they will not abuse the company, and they're not going to misuse the money and the assets of such corporations. In addition to this, we have additional procedural obligations. Procedural إجراءات, how to establish the company, even the transactions here. Transactions, because such large corporations, they deal with a huge amount of money, millions, sometimes even billions of dollars. To transfer money from company to company, if you transfer a small amount of money, if you make a transaction and this transaction costs a little amount of money, is fine, it's easy. But once you make a deal or transaction in such big companies, corporations, then it will be so difficult to transfer the amount of money and to make the transaction without having here standard of inspection and procedures and scrutiny, in which we have to make sure that everything was in place. And those decisions made by the company and corporation were according to the legal system and the bylaw. Fine, good. How many slides? How many presentations do we have? One only. Okay, good. We still have time, don't worry. We have a mutual benefit. One of the types we have, it's called a mutual benefit corporation. This is not a profit, and it's not a charity, it's not a profit. A mutual benefit corporation, it's a mutual benefit. It's a mutual benefit, and it looks like this class. It's a small club of people. It's a small unit of people coming together, having benefits from each other, depending on each other. People coming together here, having benefit only for the member. It's easy. Like the club, like having tennis club, for example, having golf club. We don't have shareholders. We don't have shares. What we have, membership. في عضوية. How many have 25 members? I can buy a membership being £5,000, for example, or maybe I can buy it by paying every year $2,000. This is a membership I bought. I can sell the membership. But then we have a bylaw. The bylaw with the internal system gives us all the information we need, we can use to be able to function and to make our activities. And at the same time here, that mutual benefit, we call it mutual benefit. What does it mean then? منفعة مشتركة. No, you cannot, as a member in such a club, you will not be able to get someone else to replace you. No. The benefit is only for the members and restricted, limited for those people. Here, even we have some assets, property for the club, for the unit. This is not a charity. It's not. It's non-profit. It's a non-profit, but it's a benefit. We have a benefit here, benefit for the members. Now, in all companies we have up to this moment, they had a status. As we go back to the definition we have, conception we have about companies, I said each company would have ID. Each company would have a name. Each one would have legal status. It means we have limited liability and perpetual lifetime. I did explain this last time. Each company would have legal status by having perpetual lifetime and limited liability. But this type, mutual benefit, there is no legal status. What do you think? Why this is the only type of corporation which does not have a legal status, no legal status? What do you think? All the types we have been talking about, they have legal status except of this. Why? Mutual benefit corporation does not have no legal status at all. Why do you have to have the legal status? Why do you have to have limited liability? Yeah, who? Shareholders. Now, shareholders in company, profit company, they would have limited liability because they are dealing with customers, with the community. But those people, they're not dealing with anyone. It's a small community. It's a closed community. They only deal with each other. If we have any conflict with each other, what can we do? If we have Samiha and Dalia, they have a conflict. Should we go to the community to ask them for a solution? No, it's not. This is a club. It's a mutual benefit. Then we have to solve it. We have to go to the bylaw. Then we don't have any need with the society. We don't have to contact the society or the customers. We don't have customers anyway. So any problem, any dispute, any conflict should be resolved within the mutual benefit corporation. And this is why there is no need to have legal status. Fine? And the benefit can go only for members. And they can employ each other. Anyone can work inside it. As we will look, as there's something called consumer cooperative. Consumer cooperative. Later on, not now. You can be a member, you can be customer, you can be employee at the same time. This is in consumer cooperative once we get to that point. Multinational corporation. Not too much, Haneen. I can hear you. We're still behind schedule. Multinational, it's easy. It's like all what we have, all the types we had before. We just can't make them at the national level. At the transnational. Some companies are established in one state, in one country, but some of them are established transnational in many states, in many countries. Some of them become transnational or multinational corporation. We can define this by
growing beyond the national boundaries to obtain sometimes remarkable positions of power and influence in the process of globalization.
And we have witnessed many of those corporations, many of them, thousands of those corporations across the world. And I don't want to name, like you can name Mercedes, BMW, Dell, Sony, HSBC Bank, Citibank, and so on and so forth. You can have huge number of companies who are working at international level. At international level. Despite this, we have sometimes something called overlapping and multiple branches. Some companies have 100 branch, 200, 500 branches. In each state, in each country, sometimes the same corporation would have 60, 70 branches. In other countries as well. And we do have what we call overlapping of layers, many branches. And what can we do here? Which we have manager in each state. We can have in each branch, we would have to have, of course, someone who would take the responsibility. Someone would be, like even sometimes in each country, you're going to have board of directors. And in general, overall, in the headquarters, we have the board of directors who would run everything for that company. For those branches, for those directors, we have something in common. One thing in common can unify all of them, which is the culture. The culture of this company. Like, for example, when you talk about McDonald's, it's the same food style. KFC, it's the same food style. And Coca-Cola, those companies have same brand, same name, same size, same shape. They taste the same. This is the culture of the company. And this is what can unify all those branches all over the world. Despite the overlapping, يعني في تداخل بين الصلاحيات, but still we have the same culture existing in everywhere. Our last slide. Tax. What do you think? How much money should the company pay tax? Good. How many times should we pay tax for the same amount of money? For the same amount of money we gain, for the profit, how much money should we pay? And how many times do we have to pay for the same amount of money as tax? If you have some profit, if you have an income, we have something called income tax. And we have even here income tax for personal income tax and company income tax. We have something called double taxation. This is happening by mistake. Double taxation is happening by mistake, by fault. We should not pay tax twice. We have to pay tax once. Now, what happens in some places, like in the UK and in the USA, they have corporate profit are taxed twice. The company pays the tax, like let's say this is the company, will pay the tax at the end of the year, and this tax will be for the tax office for the overall amount of money we made. Let's say that we made £5 million in profit. For the £5 million in profit, we paid £500,000 tax. What left is $4.5 million. This $4.5 million will be divided between shareholders as dividend, which is called dividend حصص. And after you get your dividend, after you get the amount of money, that profit, you will pay tax again for the second time. We call it income tax. And this becomes double taxation. This is not fair, because we have to pay once, not twice. Tax. Should we take this? We call it tax twice, double taxation. And this is a problem in law. We should have a solution for this. In the United Kingdom and Australia, they have a solution which is called tax credit. Okay, let's pay the tax twice. After we pay the tax twice, we can go to the tax office to claim the tax we have paid. Why should I pay tax twice? I can get a special form, and that form I can apply for something called tax credit. Tax credit. This means they would give me back the difference, how much the company has paid and how much I have paid, and how much I supposed to be at the end. It means I would suppose here to be only tax at the rate. What kind of rate? Paid the eventual recipient of the dividend. The eventual recipient, let's say that my dividend was £20,000. حصة. I supposed to be only taxed for the £20,000. How much would be tax for the £20,000? I would pay for this. I would not pay tax for the amount of money which was already made by the company, because the company would take the amount of money free of tax, tax-free, and divide it between shareholders, and then the shareholders would pay tax for each dividend. على كل حصة. I mean, this is still disputed between many countries, and some of them have solutions, some don't have solutions. We still have double taxation. We still have tax twice paid. I think the best solution is to pay tax once, but this would be on the income of the company. The company, let's say that the company making £5 million, then the company would pay the tax for that £5 million, and the money which is left behind, we can divide it between shareholders, and this would be tax-free. No paying tax for this because we have already paid the tax, not twice. Even sometimes you go to some places like restaurants, you pay tax twice. I mean, by mistake, it can happen sometimes. They pay tax. You pay tax for on the food itself. When you buy the food, you pay the tax, and this is included with the price itself. And again, they can increase, they can add tax after you pay the money. And this is not fair. And the customer would pay everything. At the end of the day, the customer would take all of this, and he would pay the difference between the tax we paid and the tax we're supposed to pay. Anyway, thanks for your time, and I see you next week.